Hello everyone and welcome to this short recording. I'm here with two traders I'm working with, and I've spent the past month watching the results, and I'm pretty amazed actually. But before we start to do the interview, it's very important to understand that this is an interview with the traders, but please be aware that the past performance is not an indication for future results, and that the video was made for educational purposes and should not be taken as financial advice. So we are not offering any financial advice here. Okay, let's get straight into it. Guys, I have prepared some questions for you. Let's just start with a quick introduction about you guys. How long are you trading and why are you so passionate about it?
Go ahead, Steph.
Hello, everybody. My name is Stephanos Christofi. I have studied in the United States. I have obtained 2 bachelor's degrees from Louisiana State University. My first degree is in business finance, and the second degree is in agricultural economics. Both of my degrees definitely played a role for me in becoming an analyst and a trader. Basically, the agricultural economics degree helped me to be able to apply the economic theory into commodities, which in turn lets me analyze the market with a different view and to be able to spot opportunities in the commodities market, besides the financial markets, forex pairs, equities, and so on.
Awesome, guys. My name is Alex Morrision. Hi, everyone. I mostly specialize in a slightly longer-term trading strategy, considering the fact that I'm an institutional trader. I've been involved in trading for over a decade now. And I analyze the markets from a supply and demand imbalance perspective, giving us an understanding of the longer-term trend and allowing us mostly to take advantage of certain positions which particular banks and big institutions may have certain pending orders onto the market. Of course, if we all look at the market from any perspective, we can all clearly agree that the price of any asset moves based on a simple supply and demand ratio. And the analysis behind it is very complex. Of course, we have certain rules of entry based on particular targets with reward protection and certain risk-reward ratios as well. We'll be able to maybe go into a little bit more detail at a later stage in the call. That's pretty much it.
Yeah, well, my first experience in trading started back in 2002 while I was still in university with the guidance of one of my university professors. I started trading futures options. It was part of one of our class. And obviously, with the development of the technology and internet, it was a decision very easy to make to jump to the online markets, because it gives you the opportunity to trade 24/7. You have the opportunity to diversify your portfolio with a single account, because we have in our fingertips the full range of financial markets, which includes forex pairs, commodities, equities, indices, and now cryptocurrencies as well.
Okay, very good, guys. Thank you for your introduction. So let's move on to the trading strategy. So maybe you can describe the trading strategy real quick, and of course, especially talk about the risk management, the different layers you are using. So yeah, let's just get started.
Right. Like Alex said earlier, we use 2 different strategies. The one strategy that I'm personally using is based on a high frequency model, which allows me to place multiple trades throughout the day with a small peak target. The one way to do it is through high frequency trading. In the high frequency model, it's basically trading based on 2 different methods of analysis. The first one is technical analysis, which is the study of charts with the implementation of technical indicators that help us identify entry points and exit points in the market. Knowing when to enter and when to exit is equally important, because it helps you to maximize your profit potential. The second method of analysis that I use is fundamental analysis, which takes into consideration any macroeconomic data that is being released on a day-to-day basis. When I'm talking about macroeconomic data, what we're basically looking for is retail sales, unemployment claims, trade balances, GDP readings, and everything that has to do with the general economic cycle.
Okay, perfect. Alex, maybe you can describe your part as well a little bit, and then we go into the risk management as well.
Absolutely. Yeah, from a supply and demand imbalance perspective, guys, if you allow me to take you back in high school, and if we studied economics, if we remember the definition, or you can quickly Google it, very simple and logic stuff, right? So basically, as Stephanos mentioned before as well, microeconomic data as well, we're looking at it from a different perspective in supply and demand. So what is it? It's, in the end of the day, a macroeconomical model of price determination in any market, right? Regardless of what that market is. It stands behind the point that in any competitive market, as we said, such as the commodity market, foreign exchange, real estate, whatever it may be, right? The unit value of a good will vary up and down, just like looking at a chart, price going up and down, up to a moment, most importantly, a price in time, a price zone in time, in which quantity demanded by consumers pretty much equals the quantity supplied by producers. And that's what they call an economical equilibrium in price and quantity. Based on certain rules, specific rules of certain demand imbalance zones or certain supply imbalance zones, where we know that there is indeed, the market is not at an equilibrium and there are indeed imbalances, we can take advantage of these particular imbalances with a very high degree of accuracy, placing certain trades and taking advantage, as I said before, of certain moves in advance. It's supply and demand is not more of a looking at a chart, taking advantage of a shorter term perspective. We try to combine the two, like Stephanos does. And I base my trades mostly on, my analysis mostly on pending orders. If Christ does this, then something will happen, pretty much. But as I said before, it's a very specific and particular set of rules.
Okay, thank you guys for the explanation so far. So of course the goal is all the time to generate profits, but what I've learned in the past, of course, the risk management is even more important than a couple percentages more or less. So Steph, maybe you can explain the different layers of risk management you guys are using in your strategies.
That your comment is absolutely correct, Merlin. The most important thing for a trader is keeping his risk management in check. That allows you to protect your profits and to have continuous growth for the account without suffering, extraordinary losses. Now, what we have done with Alex, we have basically created 4 different layers of risk management for the account in order to protect the equity, and also for us not to get overboard with any losses, or any losses that we take basically are calculated. So the first layer of risk management that we have applied on the account is the maximum drawdown, which is set at 40%. What does that mean? If an investor comes in with $1,000 of deposit, his maximum risk is 40% of that equity, which is basically $400. If in the event that we encounter a loss of $400 on an account of $1,000, then automatically all positions close. The money returns back to the client's account, and then it's up to the client, if he wishes to continue with the program, to recover the losses and continue with to profits, or he can simply withdraw his funds and we part as friends. That is the first layer of risk management that we have set. The second risk parameter that we have is that we always trade with a take profit and stop loss. So basically every position that we place, the risk is calculated and also the reward is calculated. The third parameter that we have is basically we allocate only 2.5 of the account to both traders per week. That means that each trader is allotted 1.25% of the account to trade with for the week. In the event that we reach the maximum drawdown for the week for each trader, which is 1.25%, then there is no more trading for the week from that specific trader. The other trader still has his 1.25%, can continue trading. And that is a parameter that allows us to protect profits, which is the fourth parameter in the risk management, protecting the profits that we've already generated in the past weeks or months. By using this method, it allows us to further protect the profits of the account.
Okay, that sounds very, very well planned. So let's move on to. Yeah.
I would like to add something to that, Merlin.
Yeah.
In order to reach the maximum drawdown that we have earlier said, which is basically placed at 40%, then we would need 16 weeks of continuous losses in order to reach that 40%. So
16 weeks, every single trade would have gone wrong. So then this worst case scenario would happen, right?
Yeah, which I find it a little bit very hard for it to happen, to have 16 weeks of continuous losses and reaching the 2.5 maximum drawdown per week in order to bring us to that 40% drawdown.
Makes definitely sense. I mean, a lot would have to go wrong. So yeah. Okay, but now I think it's time for sharing some results. Steph, maybe you can share your screen and show what you guys have done. Maybe sure. Alex can comment that as well a little bit so that everyone who is watching is just...
Absolutely. I think Steph will be able to show our results in the last quarter.
Yeah.
Just a second, guys.
Yeah.
You'll be able to see certain results, roughly, rough estimations, but I don't remember exact. This, can you see my screen now?
Yes.
Yeah. Okay. We have been working with the guys since April. As you can see, in April, we managed to generate 9.4% return on the account. The best month we had so far was May, where we generated 19.15%. And then for June, we were at 9%. And for this month, this is outdated. I'm sorry, I have an old picture here. I didn't take a new one today.
I'm quite sure we're on about 3.3 for the month, if I'm not mistaken.
That is correct. We are approximately at 3.5% return for the month. For this month, we still have 2 weeks to go. I believe we will definitely be on our 10% target. Guys, keep in mind.
Yeah, that's something I think we wanted to add the same thing, Stephanos. If we can.
Yeah, I want to remind people that the target is anywhere between 8 to 15% return on investment on a monthly basis. So, given the fact that now we're trying to switch to a little bit of a longer time frame model where we want investors to stay with us for 3 months, 6 months, a year, it allows us to plan our trades differently. It's going to allow Alex Morrison to trade with his method a lot better, because so far we didn't have that pillow of comfort that he knows that, you know, he can place a trade and we can keep that trade in for a duration of, let's say, a month, because people, exactly, you know, were able to withdraw at any time and so on. And every time somebody places a withdrawal request, it means that equity from the pooling account is basically being deducted, and then other people have to take the share of that trade. If he was in a trade and then he's pulling out, then his position is going to close, but that allocation is going to go to other clients. So this allows us to do better planning, and it allows to do Alex Morrison to do his trading a lot smoother and a lot better.
Absolutely. If I may add, I think in the first few minutes of the call, guys, we mentioned certain targets and risk-reward ratios. According to the maximal drawdown that Steph will be able to share with you guys, these particular results, if I'm not mistaken, April was a maximal drawdown of around 1.17%. I think May, when we achieved the 19, I think it was around 4.6%. So we always kind of trying to reach above 1 to 3 ratios. And I think in the third month, the maximal drawdown was around 0.6%. So that's of course, the results are very important, but what's even more important from my perspective as an investor as well is the maximal drawdown, the amount of risk that's actually getting allocated in regards to these particular profits that that Stephanos just shared. And yes, to add to his perspective in regards to a longer term program, if you remember, yes, I do prefer, because when we take our trades from a supply and demand imbalance perspective, I'm looking at a longer term time frame charts. For example, I look at 6 months and 3 months and 1 month charts and weeklies, for example. So when you're looking at a monthly chart and each candlestick represents 1 month, and you will stick to that trade for at least, let's say, 4 to 5 or 6 months in a trade, which would give us P&L from two perspectives, not only from the actual market doing the move that you're expecting it to do, but we also may be able to choosing assets which pay us pay us interest on a daily basis, right? Overnight. So that's an additional P&L which you're looking into when trading a longer term perspective. And Stephanos is very, very right. If we're looking at this program from a 3 months, 6 months, yearly point of view, of course, firstly, remember what Einstein said as well, right? Compounded interest is the 10th wonder of the world. So from an investment perspective, it makes total sense. And of course, from a trading perspective as well. In the end of the day, the risk-reward ratios are extremely important. And if you would give me the possibility to have long-term, much longer-term trades and not close them prematurely before hitting their targets, that would, of course, impact the overall results tremendously.
Okay, guys, thank you very much for the detailed explanation. I think I got an extremely clear picture now from every single point. I personally can add that I have an account with you guys since you started in April. And I also can definitely speak for myself that the results which have been shown here has definitely happened exact that way in my account as well. So my account has a gain of around 40% gross since I started it, and I'm very happy with it. So thank you guys for this interview, and let's continue like this for the future.